Well, good morning and welcome this morning to our economic update. Thank you for joining us today, especially on this very foggy morning. How did everyone find the fog driving here? It was quite thick, certainly from where I came from. My name is Jenny Wilcock and I'm one of the directors of Sullivan Chartered Accountants and Business Builders based in Caringbah. I'm delighted to be here today alongside Terry. Give us a wave, Terry. And Jen and Heather up at the back. As well as some of our incredible team. A warm welcome to our distinguished guests. We have Tapas Strickland, Head of NAB Market Economics. We have Susie Grant, and that's probably it from the team at NAB.
Yes, I'm just running a little bit late.
All good, all good. Welcome, and it's a pleasure to have you here this morning. Thank you. Before we dive into Tapas's presentation, just a couple of quick housekeeping items. So everybody's got an information pack on their seat. There's a notepad and a pen in there for you to take notes. We'll have plenty of time for questions after Tapas's presentation. And of course, if everyone could just make sure their phones are switched to silent. And hopefully everybody's managed to work the coffee machine this morning and has had a cup of coffee. We're thrilled once again to partner with NAB for this much anticipated annual event, helping us unpack what lies ahead in the economy. A few words about our guest speaker. Tapas Strickland is the head of NAB Market Economics and plays a key role in providing insights and analysis on the broader economic and financial landscape. He works closely with NAB Group Economics to shape their view on monetary policy. Prior to joining NAB, Tapas spent 6 years as an economist with the Reserve Bank. So we're hoping he's got some really good insights for us. We're incredibly fortunate to have Tapas with us this morning to share his insights into the current and future state of the economy. So without further ado, over to you, Tapas.
Thank you. Good morning, everyone, and what a pleasure it is to be here. I actually grew up in the Shire a very long time ago now. My parents still live in Oyster Bay, so it's always glad to be home. And I think besides last year, the last time I was in tradies was when I was 18 years old. So it has definitely changed, and all those dynamics are really, really interesting. Let me just get this clicker going if I can.
So just use the arrow.
Okay.
Yep.
Oh yeah, here we go. Use the arrow, always the case. So I had the fortunate to be here last year presenting at this conference, and the main message I was conveying then was Australia was in for a soft landing, and that broadly seems to be what is occurring. The unemployment rate at the moment is at 4.3%. When I presented last year, it was about 4%. So still very, very tight labour market, and I know many businesses are still finding it very hard to find suitable labour at the moment. Last year we were saying the first RBA rate cut was going to be in May of 2025, and obviously that occurred in February, but it looks like it is in train that we're going to get a couple more rate cuts through this year. So at NAB we think the RBA cash rate will get down to 3.1% by early next year, but we also don't think rates will go too much lower than that in this cycle, and I'll show you a few charts on why. The main reason is cost pressures being faced by businesses are still relatively high, but most businesses that we ask are still finding it very hard to pass on those costs. And so if the economy picks up too quickly, then you're going to have inflation settling a little bit above the midpoint of the RBA's 2 to 3% inflation target. Where we were most wrong about the economy, and as a forecaster, it's very hard to forecast the future, was on the Australian dollar. So our forecast last year, middle of last year, was for the Australian dollar to get up to about 70 US cents. It's currently around 64.5 US cents. So that's probably where our biggest forecast miss has been. Our FX strategists still see the Australian dollar rising to about 70 US cents by the end of the year and 73 US cents by the end of next year. And that's primarily because we think the US dollar is going to be on a secular weaker trend due to all the uncertainty that the Trump administration is putting out there. Just in terms, just covering back onto our RBA view. So as I was saying before, we do expect the RBA cash rate to be cut to about 3.1%. Markets are broadly pricing out at the moment, although I think market pricing has drifted a little bit lower. So for those of you who have clients, or there is that opportunity out there that you could potentially lock in those interest rate cuts earlier than they are potentially being delivered. But in terms of where we think rates are going to settle, I think it's worth keeping in mind this concept of a neutral interest rate. And that's the RBA cash rate that keeps unemployment low and inflation broadly at target. And the RBA's model suggests that neutral rate is probably around 2.7 to about 3.5%. And so that's the reason why we think rates are broadly going to be troughing at around 3.1% in this cycle. Just to illustrate how tight the labour market is at the moment, I think it's just useful to think about where we were in 2019. And in 2019, the unemployment rate across Australia was 5%. It's at 4.3% now. So the labour market is still much tighter than it was prior to the pandemic. And at the same time, although activity has softened a little bit in terms of growth, firms on the whole are not retrenching staff. So when you look at retrenchments, they're below where they were prior to the pandemic as well. So the way I like to think of it at the moment is really a low firing equilibrium going on in the labour market. Although it is quite clear the pace of hiring has slowed, and particularly in the youth market, that's where the slowness has started to emerge. And I do wonder if you're starting to get a little bit of the transition towards AI, more firms starting to adopt AI at the margins, and maybe that's putting a little bit of pressure on younger labour markets. One reason why we don't think the RBA cash rate will be cut too much further beyond 3.1% is the chart on the left-hand side there. So at NAB, we are Australia's largest business bank, and we have the privilege of surveying a lot of our clients. One of the outputs of that is the NAB business survey. We survey about 400 businesses a month. And most of them are still saying labour costs are growing at elevated rates, purchase costs are growing at elevated rates, but final prices are not growing at elevated rates. So it does seem like there's a bit of margin compression going on. Indeed, when we ask firms about what rate is your profitability growing at, how are your margins going at, margins in our survey at least are contracting and profitability is edging lower. So it is that environment where there's still a lot of cost pressures out there, and it is pressuring some firms. On the optimistic side though, when we look at the ASX 200, so this is the bigger listed corporate space of course, we did see that compression in margins occur over the past couple of years. But what we have seen now is a bit of a stabilisation in those margins. And for those of you who haven't studied accounting, like everyone at Sullivan has, an operating margin is effectively just sales over EBIT. And so you've started to see that starting to stabilise. So hopefully firms are starting to feel a little bit more comfortable in terms of costs at the moment. In terms of where the economy is right now, so as I was saying before, NAB is Australia's largest business bank. We can look into our card data and see the trends that are going on at the moment. And this data is for May, but it is also reflective of the trends that we saw in June as well. So there's two key dynamics going on at the moment. There's a big state divergence and there's a big demographic divergence going on. So I'll just go to the state divergence. The most underperforming state in Australia is Victoria, and you can see that with our consumer spending per capita year-on-year growth. Greater Melbourne is only growing by 1.6% year-on-year. Now this is on a per card holder basis. So growth has been very, very subdued in Melbourne, and growth in Sydney has been the strongest at 3.8% year on year. So conditions in Sydney here are not the same as the conditions being felt in Melbourne. So things are doing relatively positive here. For those of you who have exposures to what's going on in Brisbane, Brisbane is also relatively strong as well. And I think the Queensland economy is going to be one area of strength going forward, just given the Olympic build-out that's going to be occurring there over the next couple of years. So that's on a state basis. On a per capita basis in terms of demographics, what I find really interesting is over the past year or so, a lot of weakness in people who are under 25 in terms of spending. And I think the under 25s are the ones who have been really crunched by this cost of living squeeze, really crunched by the aggressive rise in rents that we've seen over the past couple of years, although that's starting to moderate now. So that should be a bit more supportive in that age group. And the other age group that's seen fairly soft spending trends is those people who are aged 45 to 54 years. There may be some of you in the room in that age group. And I think in that age group, being really squeezed by effectively elevated interest rates relative to maybe where they borrowed at, but also in that 45 to 54 years, also dealing with a lot of societal changes. So they may have aging parents that they have to support. They also may have kids that they have to support as well. Good news though is as interest rates start to fall, that should free up cash flow for those people who are aged 45 to 54 years. And so we think we should continue to see a pickup in consumption growth in the second half of this year and into next year. For those people under 25, we're starting to see in May spending starting to increase again, and so we're quite hopeful that you're starting to see the bottom in terms of consumption growth and that you start to see that picking up. And just worth noting, for those people who are 55 to 64 and 65 years plus, spending has been relatively robust in that category, which is no surprise given all the commentary that we have heard there. By state, as I was saying before, Queensland I think is the strongest state at the moment. Business conditions in Queensland have been well above average for quite some time. In New South Wales, where we are, they've been about average, and in Victoria, they're below average and actually negative at the moment. So Victoria is very, very subdued. Talking to some corporates recently, a lot of people were saying, well, is this the bottom of the Victorian market? Should I be positioning my business because it's now the bottom and maybe there's growth opportunities in the future, just given there's been that relative underperformance in Victoria. And the reason why I say this is I was in Darwin recently, and we're talking about dwelling prices in Darwin. And for those of you who follow capital city dwelling markets, Darwin prices until most recently had done nothing. And it used to be Darwin used to trade with a beta to prices in Adelaide and Perth. And what you did see in the latest CoreLogic data, which is now called Colality, you saw Darwin dwelling prices rise by 2.2% last month. So where there is underperformance relative to other states, I think there will be eventual catch-up, but timing that catch-up is going to be very, very difficult, of course. By different industry sectors, retail trade is the weakest sector, and I don't think that's surprising for many people in this room. I think in retail trade, obviously the cost of living squeeze, you've seen trading down and trading across. So I think that's quite well explained. The other aspect of it is you've seen that online share of sales continuing to rise. Coming out of the pandemic, you saw a bit of stabilisation as people started to interact with each other. In the last 6 months, you've started to see that online share rise again. And I think there's been that build out of logistics space, build out of industrial space, that's enabling that online share to rise. So at the moment, non-food retail is about 18% of online sales. In the UK, that's about 30%. So there is that opportunity for that to further rise, and that's going to pressure bricks and mortar retail. So that's one headwind to retail that we've been highlighting. The strongest side of the economy is obviously the services side, particularly recreational personal services and finance, property and business services. Everywhere else, it's a bit of a mishmash. Construction, very, very divided. If you're in construction associated with infrastructure or with a luxury downsizer market, doing relatively okay. But the entry-level build for resi still very much struggling in terms of margins. So I think it's going to take some time for that to start to turn. The household sector, though, I think is still in a very, very good shape. And I may have presented these charts to some of you last year. The key chart that I find striking is the chart on the right-hand side there. The amount of money sitting in offset account balances for mortgage holders is equivalent to $308 billion. So there's a lot of money just sitting on the sidelines that potentially could be drawn down if people become more comfortable with the level of rates or more comfortable with the level of income growth. And that's actually offsetting about 12% of debt at the moment in the system. The other aspect of it is, and I know there's a big distribution impact, we're probably at the upper end of the distribution relative to other people, but net worth of the Australian household sector has increased by 61% since the pandemic began. A lot of that is driven by dwelling. So dwelling wealth held by the household sector has increased by 66% since the pandemic began. And equities held by the household sector have increased by 48% since the pandemic began. So the household sector overall is in a really good shape, and many parts of it are relatively wealthy. The other aspect of it is, even though we saw interest rates rise quite sharply, arrears rates are pretty much where they were prior to the pandemic. So there has been no dramatic rise in arrears. And I think you can clearly see this is, as interest rates rose, people still made excess principal repayments. And indeed, maybe some of the subduedness in consumption growth is because people were making excess principal repayments to offset some of the debt and alleviate some of the interest rate rise. In terms of why we should still be cautious about inflation, inflation in Australia measured by the CPI, consumer prices. Consumer prices is just a basket of goods. One bit of that basket is housing costs. And it turns out in our analysis that housing costs are actually very important for the overall CPI. So rents are very, very important. New dwelling construction costs are very, very important as well. For those of you in the construction game, you may be surprised to see the contribution of new dwelling construction costs to the CPI has fallen over the past year. So the statistician measures this as how much is charged to the end buyer. So if the housing market had been a bit slow last year and developers were discounting a bit of stock or adding bonus inclusions in to clear stock, then that shows up as a price decline. The question we have to ask ourselves though is, as interest rates continue to fall, is it likely developers will continue to discount stock? And in which case, the green bars start to rise again, and that presents a bit of a challenge in terms of sustaining inflation at 2.5%. So I think that's one of the reasons why, for the RBA at least, going below 3.1% probably is going to require greater slowdown in the economy or a bigger global shock. And at the moment, we're not seeing that bigger global shock, although it could be a shock out there at some point in time. The reason why I highlight this is when you look at dwelling prices at the moment, they're growing by 3.7% year on year or 7% annualised. You look at CPI new dwelling construction costs, they've hardly grown over the past year. But you look at the average dwelling house approval value, that's grown by 6% over the past year. So big divergence between what the statistician is recording in the CPI and what is actually occurring in the actual market at the moment. So in terms of interesting trends, the big interesting trend obviously is how dominant the government is becoming in the economy. So government spending is the highest share in the economy since the 1980s. So for those of you who have long memories, we're almost in that 1980s world in terms of the government's role in the economy. That's starting to crowd out the private sector. So when you look at business investment actually has been flat over this period. And on the construction side, you can clearly see that crowding out of materials, crowding out of labour. That's part of the reason why the labour market is so tight for construction at the moment. So there are genuine conversations to be had about how large should the government sector be in the economy at the moment. Productivity is a big buzzword at the moment. What I really like to look at is, well, what sectors are at the productivity frontier? So the productivity frontier, look at the country that has the best productivity. How does Australia relate to that? Turns out we're actually at the productivity frontier for many different industries. So you look at retail trade. For example, if you go to Woolies or Coles, you got self-checkout. Woolies is starting to introduce automatic gates now, so they have less security. There's a lot of at the productivity frontier in that sector. Where we're not at the productivity frontier is in construction, and interestingly in utilities. So actually when you look at Australian productivity compared to US productivity, exclude mining and the non-market government sectors, our private sector economy is actually fairly close in terms of the US in terms of productivity trends. So I think that's an interesting aspect to the debate that isn't really well recognised. Construction productivity, though, is a big problem in our economy. When you look at the level of productivity in construction, in dwellings, we're 12% less productive in building a dwelling than we were back in 1994. If you think of just the ability to house someone, so exclude changing floor plates and dwelling sizes, just the ability to house someone, we're 53% less productive in our ability to build a new dwelling to house someone. So some very big areas that need reform, and I think these are potential areas where could be opportunities for businesses, whether that's in prefabrication. So you're starting to get a bit of prefabrication happening, especially in the land lease communities, those kind of areas. But maybe that's one area where the building sector can start to develop. AI is the other big trend, obviously, that's going on at the moment. There's been a lot of studies done to try and estimate AI's impact on productivity and on the business sector as a whole, and it's very, very early in this stage. I had the privilege to be at a breakfast with the OpenAI chief economist recently, and his view was we're still at the very, very early stages of AI adoption. Their adoption rates for personal subscriptions were absolutely through the roof, but their enterprise adoption was very, very low. So it could be that employees in your own businesses are using AI much more intensively than your own business is. So I'd encourage you to have a conversation with your employees and see what exactly are they doing and whether that has potential application for your own businesses as well. But in terms of actual studies, there was an OECD study that estimated productivity benefits of traditional AI was between 0 to 11% at the organisational level. So that's a pretty big range. In a real-world study of AI, a multinational company, Procter & Gamble, found that individuals randomly assigned to use AI performed as well as a team of 2 without it. So basically, a person could do the output of 2 people if they had AI. So I think that is really, really interesting. From an investment point of view, and I sit on the global market side, so I'm always thinking on my investment hat. The US was once the only place people thought you could get investment exposure to AI. But with DeepSeek that came out early this year from China, more people are starting to realise there are other countries out there with AI applications. So that may have some implications out there. I mentioned before some of the headwinds going on in the retail sector, and I think this chart really shows it really well. So this is the online retail as a share of total retail, and I'll just draw your attention to the grey line, the non-food retailing. So a big spike during the pandemic, obviously, as we couldn't go about, and then a flat line, but now we're starting to see that trend back up again. And I mentioned before how in the UK that stands about 30%. So I think as more industrial space gets freed up, more logistic space gets freed up, particularly with the second Sydney airport coming online later this year, I think that online penetration ratio could continue to rise. The other interesting aspect I find is food retailing. So food retailing, a lot of people thought people wouldn't be willing to shop online for groceries. I'm a father of two relatively young kids, and online shopping has been an absolute saviour. Food retailing at the moment is about 7% of total food retailing. So I think those pressures on food retailing is going to continue as well. So that's just worth keeping in mind. A big trend at the moment that we're being asked, particularly by corporates, is Ozempic and GLP-1 drugs. So for those of you who are unfamiliar, Ozempic obviously is a diabetes drug that has also been found to reduce appetite or appetite suppression. And so there are some studies out there that are saying this could have pretty dramatic implications in terms of alcohol consumption and also in terms of food retail as well. So the first one is households with at least one GLP-1 user reduce grocery spending by 5.5% within 6 months of adoption. So I think that's pretty interesting. And then the other one was average alcohol intake decreased by about 2/3 for people who are using these drugs. And I know in the alcohol industry itself, it's under a bit of strain at the moment. If you look at the share price of Endeavour, it's halved basically over the past couple of years. There's definitely the cost of living squeeze playing out in terms of alcohol consumption, different demographic trends, so people in younger cohorts seem to be drinking less, but also maybe there's some adoption of these drugs by people who are not taking it for diabetic use. Just one emerging trend that we're being asked about from from our corporate clients. Working from home. So for capital city office workers, it looks like that has broadly stabilised. It's stabilising about 75 to 80% of what it was prior to the pandemic. So it seems like for people who are commuting, say from the Sutherland Shire to the CBD, 3 days in the office, 2 days at home seems to be pretty normal and pretty widespread. There's been attempts at trying to boost this up, but it hasn't really worked. And for those of you who I'm having trouble interpreting this chart, this is just Sydney train station exits at some key stations there. I put Sutherland here, and Sutherland is at 77% of what it was prior to the pandemic. The other challenge, obviously, at the moment is we've still got really strong population growth. So population over the past year has increased by 445,000 for those people who are aged 15 years and over. That's equivalent to population growth of 2% a year. But we're only building about, or at least approving, 187 dwellings. So that dwelling shortage that we've been talking about over the past couple of years, that's going to continue. That's going to that's going to keep the dwelling market relatively tight. And I don't really see that changing in the near future. The final trend I'll make a comment on before going in terms of what's going on globally is population aging. I was showing you before how there's a lot of population growth, but the population who are 65 years plus are starting to grow as a proportion of the total population. To the extent over the next couple of years, each year there'll be about 200 to 250,000 people who fall into that 80 years plus bracket. So from a consumer point of view, from a business point of view, who your end client is, some of them are going to be increasingly aging, and they'll have different needs as well. So in terms of shocks, so the biggest shock obviously is what's going on in the US with President Trump. The key thing to note though is President Trump has a broad mandate for what he's doing. As much as how we interpret the US headlines, it looks like the US electorate is giving him a broad degree of latitude to pursue his policy agenda. And the key thing to note is President Trump's net approval rating is as high as it was during his first term, and certainly higher than President Biden when President Biden left office. So I don't think it's really going to change effectively. Now, it's very easy to get carried away with headlines, but if you actually go into the underlying arguments that his policymakers are trying to address, I think they're quite rational, and that can kind of give you a bit of perspective of where things could go and also the opportunities that could open up. So the first observation his different advisors have said, the US spends a lot of money on defence, helps its allies out on defence, and their allies aren't paying enough on defence. And that's pretty true. So if you look at US military spending as a share of GDP, the US spends about 3.5% of GDP on defence. Australia spends about 2% of GDP on defence. And the Europeans, until most recently, spent about 1 to 1.5% of GDP on defence. So the cost to the American taxpayer to provide this US security umbrella is rising because now the US is no longer the world's largest economy, hasn't been the world's largest economy since 2016. And I think this quote by the Polish PM is probably the most pertinent. Early this year he said, "It's striking, but it's true. Right now, 500 million Europeans are begging 300 million Americans for protection from 140 million Russians who've been unable to overcome 50 million Ukrainians for 3 years." So some sense that Europe should pay their own fair share of defence, defend their own territory, and I think it's quite rational from a US perspective. Now, what does that mean for businesses? So Australia at the moment is spending more on the NDIS than we are on defence. I think the government is going to be under a lot of pressure from the US administration to lift up defence spending, and I think the pressure tactics that the US administration, whether you like it or not, have been very effective in getting other countries to lift up their share of defence spending. So if Australia went from 2% of GDP on defence to 3.5%, that's about $40 billion each year. Then you have to think about, well, what sectors could be exposed to that from a business point of view, and I'll leave that for you to have your own discussions about. But that's just worth thinking about one potential growth opportunity out there. The second observation is the US has been quite worried about the large trade deficit they run with a lot of countries. The biggest trade deficits they run are with China and with the EU, and this is what all the tariff announcements have been. From an Australian perspective, what we want to know is the US seeking to totally disengage with China, or are they seeking to protect some industries, which would be relatively okay from Australia's point of view, given that most of our exports go to Asia. So I think the Treasury Secretary of the US in 2025, I think this was quite pertinent. He said, "We do not want a generalised decoupling from China, but what we do want is a decoupling for strategic necessities which we were unable to obtain during COVID, and we realise that efficient supply chains were not resilient supply chains. We're going to create our own steel, protect our steel industry, work on critical medicines, on semiconductors." So I think that viewpoint should still be broadly positive for Australia. The US is not seeking to totally disengage from China, still be trade. China obviously will need to pivot inwards towards more investment, towards more consumption, but overall we don't think it'll be a big impact on the Australian economy. So I think that's broadly positive. In terms of asset markets, what have they done? They've been broadly positive with what has been occurring in the US. When you look at equities, say the S&P 500, that's up 11% since when Trump was elected. You look at European equities are up about 6% since when Trump was elected. One thing that's quite important though for Australia from a trading point of view, particularly in terms of the Australian dollar, is the US dollar has fallen 4% since when Trump was elected. So we do think there are some uncertainties with the US regime that's going to create downward pressure on the US dollar, and that should create a bit of upward pressure on the Australian dollar relative to the US dollar. And that's part of our reason for why we see the US dollar at 70 US cents by the end of the year and 73 US cents by the end of next year. Interestingly, the two best performing asset classes since when Trump was elected was gold. So gold is up about 21%, and I think there's some real fundamentals in the gold market that should see that go higher, and cryptocurrency. So Bitcoin here up 70% since when Trump was first elected. In terms of why I think Australia is still well placed, Australia exports a lot in terms of commodities, in terms of agriculture, but also in terms of manufactured products as well. A lot of people talk about China. Indeed, China's population peaked in 2021, and China's population is due to decline as people get older in China because of the one-child policy. But importantly for Australia, we have exposure to the ASEAN countries. Their population doesn't peak until 2054. And even in India, their population doesn't peak until 2062. So there's plenty of growth opportunities for Australian businesses out there in terms of wider exports. The other interesting aspect of it is if you look at urbanisation rates, so how many people live in urban areas relative to rural areas as a share of the population, both the ASEAN countries and India are not very urbanised compared to the OECD average or the advanced economies. If you make this heroic assumption that one day the ASEAN countries and India will get to the same urbanisation rates, say as Japan and South Korea did, that would be the equivalent of 210 million people in ASEAN moving to capital cities. Think of all the infrastructure needs, all the build-out would be needed for that. And it'd be also the equivalent of 666 million Indians moving from rural areas to capital cities. The reason why I mention this is back in 1990, there was about 550 million Chinese living in rural areas who could have been going to city areas, and that stands at 232 million now. So our prosperity over the past 25 years has been underwritten by 250 million Chinese people moving from rural areas to capital cities. Now, just imagine if the ASEAN countries and India got their act together in terms of the ability to urbanise. It'd be quite beneficial for Australia. So that's the main reason why I'm still relatively bullish on Australia. In terms of the Aussie, I mentioned before how we think the Australian dollar will get to about 70 US cents by the end of this year and to 73 US cents by the end of next year. That's really predicated on the US dollar getting weaker. When we look at our Australian dollar models right now, they're pretty much saying the Australian dollar is at fair value at around 64.50. And I think that's broadly it in terms of the presentation. But to reiterate the key points are, I think the Australian economy is still in for a soft landing. The household sector is still in really, really good shape. Because of that, we think the RBA cash rate will trough at about 3.1%, which we think is broadly neutral. For rates to go much lower than that, I think you need a greater slowing in the economy or a greater offshore shock. And so far, we haven't seen it, despite all the uncertainties going on there. Secondly, I know the headlines can be quite aggressive, but if you go back to what Trump's advisors are trying to address, military spending disparities, trade disparities, I think there are opportunities for Australian businesses in that environment, even though there's a lot of uncertainties out there. Thirdly, just in terms of where we think the Australian dollar is going to be, we think the Australian dollar is going higher, but only because the US dollar is weakening. So we don't see too much progress on cross rates. So Aussie Euro, Aussie Sterling, we don't really see those changing over the next year. Thank you so much for your time and look forward to any questions if you have any.